while we talk about the next subject of conversation, debt funds, which have always been considered as a safer investment option, especially during volatile markets. However, we've been talking throughout the day the rising interest rates, a volatile macro environment, and higher yields have likely impacted investors' investing preferences within debt markets. And in our next conversation, we're trying to understand the debt fund investor outlook as of now in 2022. For this conversation, I'd like to invite on stage Head Fixed Income Axis AMC, R. Sivakumar, CIO Fixed Income Mirae Asset Investment Managers India, Mahendra Jajoo, CIO Fixed Income ICICI Prudential Mutual Fund, Rahul Goswami, and founder Bonds India, Ankit Gupta. Can we have a huge round of applause for our power panel? Welcome to the stage, gentlemen. And Neil, over to you.
Ankit, let's turn now to credit risk. A lot of mutual funds turned risk averse after various episodes, and the yields became unattractive. So people began to go to bond platforms to directly buy debt, high yielding debt. And now SEBI has come out with a paper that says that these bond platforms should be regulated. They should be registered as stockbrokers. The trades on them should go through exchanges and not directly. So is this a step in the right direction? And what is the future for bond platforms?
If you ask me, this is really a step in the right direction, because if you see any market which is regulated helps the market to grow. It builds a lot of investor confidence. So this was rather required way back when the bonds platform were launched 2 years back. A lot of bond platforms mushroomed over the last 2 years. So there has been papers which are being sold which are not really creditworthiness for the retail to be sold. So they're not exactly for retail, because the retail doesn't go deep dive, understand, or does a research in buying a bond. So they go by what the platforms are selling. So yes, the regulation by SEBI or the consultation paper by SEBI is a welcome step. It will effectively regulate the whole market. The platforms will be regulated. There will be a lesser counterparty risk, because most of the platforms, if you see, were doing a counterparty settlement which was not regulated through exchange. So sometime a bigger broker, this is a phase which is like a 92, 93 of the equities market, wherein a lot of money was taken, it was done on a Bajaj Badla, and then the money was moved out of the system. So that is something which needed to be controlled, because a money going into a broker, parked there, might have been a bigger scenario. So it's a welcome move. Definitely it will help growing the market. It will build the investor confidence. And yes, what we need to see here is how does SEBI regulate the bond market in terms of supply, in terms of the credit quality, and how does it save the investors' perseverance to risk?
But will the bond platform survive this regulation if it is implemented in full? How much of the industry will survive, do you think?
In fact, this industry will grow when this regulation comes in, because what will happen, this is an attractive platform to work on. This is an attractive business to do. It attracts the retail investors. The only thing which was missing out there was the regulation. So a lot of people were not entering into this business because there was no regulation. We didn't specify any regulations till this date. When the regulations have come in, people are welcoming the steps. In fact, SEBI has come out with discussions on viewing the bonds platform, how are they operating, what is the process, and things like that. So the way they came out with the regulations on stockbroker as to the way of operations of stockbroker, I believe they would come out with operations on them as well. What is required to be seen here is, yes, the survivability is not an issue. What is required out here is the supply. What is happening if you want to distribute bonds to the retail, and the retail needs to be present in bonds market, what you need is a smaller face value. People like a regular retail or a middle class would not come and buy a bond which is worth 10 lakh rupees. Right? So what needs to be taken as an action is, how are you reducing the face value? How are you growing the market so that the retail can accept it?
Post the regulations, what is the minimum? Like, can I invest 1,000 rupees through a bond platform?
As of today, you can invest 100 rupees through a bond platform. Why? Because a face value of bond is what you can trade, right? So if I essentially go and buy a government security or a GSEC, it is 100 rupees, right? So if you go and buy a face value of a bond which is 1,000 rupees, you can buy a 1,000 rupees bond. So essentially different platforms have a different minimum criteria of selling the bonds. But then again, as a retail investor, you can definitely buy a bond worth rupees 100,000.
And that's not going to change.
That's not going to change. That's definitely not going to change because SEBI itself wants to grow the retail market. And in order to grow the market, they need to give that supply. They need to give that regulation so that the retail can come and participate in the market.
Right. Now, there's also this RBI platform for directly buying government bonds. Doesn't seem to have taken off that much. And, instead of going through that, you also have gilt funds, you also have long duration funds, which can potentially offer you a more tax efficient route. So, Shiva sir, I just want your thoughts on this, that is the RBI retail platform really attractive if you think of the alternative?
Can we not create a listed, publicly traded bond market with retail institutions, everyone participating? And why we can do that in equities? Mutual funds trade same stocks as retail investors trade. Why can't we trade the same bonds as retail? Why can't retail participate in the same bonds that mutual funds are trading? So I think we have to think big in terms of how do we get people invested. And that cannot happen, as he rightly said, it cannot happen if the face value of a bond is 10 lakh rupees, 1 crore rupees. It has to happen for small values and it has to be really accessible to investors. If stocks can have par value of 2 rupees and 1 rupee, why can't we have bonds having value of 100 rupees and 1000 rupees? By the way, GSEC minimum is 10,000 rupees. Not
We're selling at 100 on our platform.
You're selling at 100 rupees?
Yeah. One GSEC at a time.
Okay.
So just to add to what Mr. Sivakumar said, the bigger problem is education. Now, what you see is we are not doing something which is new. This has been done traditionally by the old brokers, right? So bonds were being sold to retail earlier in some way or the other, though it was concentrated to the major cities in India. But then again, what we are trying to do is just democratize the market. Why? Because at the end of the day, a guy who is sitting at a remote location in a small village, he has only one option to do an FD, right? But then he is not even aware of the bonds. So the bigger challenge which we are facing as a bonds platform is more of an education. How do you educate the customer? Once the customer is educated, then there is no brainer because at the end of the day, he's comparing this product with a fixed deposit. So what we see as a challenge is, yes, one is the face value, definitely. The other thing is education. So that is where the regulator needs to step in, decide how to decipher, how to give education, impart education to the retail investors so that that confidence is built up.
Ankit, correct me if I'm wrong, but there was a modus operandi where the platform would buy the entire issue in a primary issuance and then offload it to retail investors within 15 days, 20 days, etc. Now, SEBI has said that you have to lock in for 6 months. Before that, you can't. Post that, does the industry survive?
See, very frankly, in industry, you see two kinds of platforms, obviously. One is simply which is doing the business, which is trying to make the business easy. Now there comes a business wherein there will be platforms which would be buying the stock. You would not have heard the name. So there are two ways to look at the business, right? One is doing the business in a simple way, the way you are doing it. The other is you are buying something which the retail is not aware of and then selling it. So when you want to do a business, the business has to be done on a going concern basis. The objective of a long-term association, the objective of creating a long-term confidence in the retail investor is something which is required. So if that is being fulfilled by a platform, obviously they will survive. But then again, if the thought is a short-term greed over a long-term investment or a long-term commitment is something which you need to look at into your business model. Okay. So that would be specific to a platform. That can be specific to you can say a platform or a portal. But then it's not generalized to the industry.
Thank you so much. It was a lovely discussion. And, the cycle is once again, in a sense, turning from all equity interest to some interest in both debt and equity. Thank you all very much.
Right.